Hey, welcome back. Happy Saturday again. I thought in this video I would talk a little bit about my plans for what I'm going to invest into once I cash out of Greyscale after this bull run, what I'm going to do to increase my wealth further, and then when I'm going to get back into the crypto bull run for next cycle, when I'm going to do it, how I'm going to do it, all that kind of stuff. So I'll talk about this. As usual, none of this is financial advice, just my opinion. Just my thoughts on things too. Like obviously I've got, some time before I cash out. And so things can always change as I do research and kind of figure things out and all that kind of good stuff. But generally, I'm going to do this with my three portfolios. My main portfolio, I'm going to also do it with my SEP IRA account, and I'm going to do it with my son's UTMA account. Basically the same things. So first of all, the first thing I'm going to do, and this is probably only going to be in my main portfolio, not my SEP, not my son's UTMA, but I'm going to keep a portion of my profits that I plan on investing. By the way, like I've said, you're going to want to, and I'm going to do this too, spend some of my profits on nice things, right? For myself, and you should spend some money on yourself for nice things. Get out of debt, go on vacation, do whatever. Depends on how much money you make, obviously. But for what I have left to invest, I'll probably reserve in my main account, probably about 10% of my account will just be in a cash position to basically capitalize on good opportunities that I see, in the next year or two beyond that, from the point that I actually kind of rotate into investing in things. I'll probably leave about 10% or so in a cash position. Now, inflation is working against me. Any money you leave in your bank account or brokerage account, you have inflation as your enemy. So you don't want to stay in cash too long, but there are good opportunities to come along in stocks, index funds, things like that, that when things go on a downturn, like if you have a cash position, well, that's where you can act and you can move into that. So I'm going to, probably like 10% probably is what I'm thinking right now, cash in my main account. I don't think I'll do this in my son's UTMA or my SEP. I think I'm just going to go full on into 100% into different assets to invest in. So that's the plan there. Okay, so what are the assets I'm going to invest in my main account, in my son's UTMA, and my SEP IRA? Well, I'm going to go into a couple different classes. One, I'm going to allocate a percentage, and I haven't figured out exactly the percentage yet, but a percentage is going to go into index funds like VU, like VGT, things like that. Okay, so a portion into index funds. Then I'm going to reserve a portion for growth stocks that I might want to get into, whether that's Nvidia, Apple, Microsoft, something else. I'm obviously going to be looking at the charts, looking at what people think the stocks could do and all that kind of stuff. Tech is going to be around for my entire lifetime, your lifetime too. But that doesn't mean we might not have a big pullback in Google, in any, Microsoft, Apple, any of the stocks out there, right? So that's why it's important to have a cash position, in my opinion, to be able to capitalize on that when there are drawdowns, drawbacks, pullbacks, crashes, all that kind of stuff, that you can actually invest into those things. So a portion is going to go into performance growth stocks like Apple, like Microsoft, etc. Then another portion is going to go into high yield dividend ETFs. Now, I was kind of burned. I felt burned and disillusioned by a lot of high yield dividend ETFs because of the significant NAV erosion that's present. If you do the math, you look at funds from Defiance, they have pretty bad NAV erosion. And when I did the calculation, I'm like, you know what? After I pay taxes and distributions, and I take into account the erosion of NAV, I'm not doing anything. The only people making money are Defiance and the IRS. This is not cool. So I felt kind of burned. And obviously, like the yield max stuff, it's like I'm not a huge fan of some of them because of the big pullbacks, the big drops that they have, as evidenced by funds like Tesla, right? But there are some yield max funds that were performing well in terms of not having NAV erosion. And I haven't looked in a couple of months. These could be different. But I think it was MSFO, PayPal, the PayPal ETF, and a couple others. I think they were doing okay. So what I'm going to do about a year from now is I'm going to take a look at the chart and see where things are going and look at what people think like the underlying stocks could do and make a decision, because I might go into some of the yield max ETFs that don't have NAV erosion, but I will also do a calculation and just say, well, does it make more sense if I just buy into the underlying stock, i.e. PayPal or Microsoft, versus going into the yield max ETF? I'm going to do that calculation. But one of the high yield ETFs that I probably will go into for sure is FEPI, F-E-P-I. This is by RexShares. It has a 25% yield, which is great, very nice. It does not have NAV erosion, which is really good, at least not yet, but things could change. I'm going to be watching this thing over the next 9 to 12 months, and I'll make a decision then. But, you know, the downside is, I guess it's the downside, is they're paying distributions, or they have been, using return of capital, which means my money, if I put it in there, is coming back to me, which isn't ideal, because it tells me it's like there's some kind of problem with the fund. It's like, why is my money coming back to me? But it does have some positives. Like when my money comes back to me in terms of return of capital, I'm not taxed on that distribution, which is awesome. The side effect of that is that my cost basis in FEPI goes down over time. Now that means when it comes time to sell FEPI, right, that I'm going to be charged capital gains taxes, which if I've held it for at least a year, I will be able to achieve long-term capital gains taxes, which is better than the short-term rates that essentially you get charged from normal distributions from high yield ETFs. So I like FEPI so far, but I will be watching to see what happens with that. Okay, but FEPI is one of the high yield ETFs I plan on getting into. Okay, so far I've talked about a couple different things. One, I'm going to have a cash position. 2, I'm going into some index funds. 3, some performance stocks. 4, high yield dividend ETFs. Okay, so that is probably what I'm going to go into for my main portfolio. There's one other thing I might go into my main portfolio that won't go into the others, and that is precious metals. And I will do it probably primarily into gold through the Sprott Physical Gold Trust, which is ticker symbol PHYS, Fizz, PHYS. And the reason I'll probably go into that versus the Physical Silver Trust, which is PSLV, is that silver has not been performing as well as gold. And there's a lot of conjecture that, silver has been manipulated and its price has been suppressed. A lot of people think it's going to explode, which it might someday. But somebody also said, and I thought this is very wise, it's like, well, if you assume that the price of silver has been manipulated for so long, what's to ever think that manipulation is ever going to end? And that's very true. So I look at it and I go, well, if I want to hedge my bets and have an anchor, as it were, against the instability and insecurity of the financial markets, I do like precious metals. So I will probably put a little bit into primarily that PHYS, the Sprott Physical Gold Trust. And I don't know what percentage yet, but I'll probably stick some there. So I won't do that in my SIP IRA account or my son's UTMA. Essentially, in those accounts, I'm just going to go into 3 main things. One, like I said, index funds, high yield dividend ETFs, and growth stocks. And I might even I might skip the growth stocks for like my son's UTMA or my SEP and just stick it into index funds and high yield dividend ETFs to grow the wealth, right? So we'll see when I actually get there, what decisions I kind of make on that stuff, but that is the plan. So I've talked about this before. After you cash out, you have a period of time to wait before you can really get into the bear market at really good prices. And so if we look at the calendar and the track record of previous bull cycles, basically what I think is going to be the best time frame to reinvest into Greyscale Trust, into native cryptocurrency, into Bitcoin ETFs is the period of time between December of 2026 and December of 2027. There's about a 1-year period where things probably will be at very good price points. So, I mean, if you cash out, by early 2025, the Greyscale stuff, well, you have a ways to wait. I mean, you've got a 1.5 years to wait. So in that time, if you put your, like for me, it's like if I have my stuff in index funds, that probably will grow at an average rate, assuming we don't have like a recession and a major pullback in the markets, But if we don't, probably by 10% per year. And FEPI, you know, for example, as a high yield dividend ETF, is generating 25% per year of whatever I have allocated to it. So in the period, like a year and a half between when I cash out and when I start going back into the bear market, well, that's a year and a half for my money to grow, right? And next cycle, I'm not going to put my whole portfolio into crypto, you know, either native crypto or Greyscale trusts or Bitcoin ETFs or whatever. I'm not going to go all in. I am this cycle. I'm like 99% now. I got rid of some stocks and I basically ejected almost everything. And basically everything is in Greyscale. That's in my brokerage accounts. So I'm like 99% Greyscale in my brokerage accounts. Probably even more than that, but I'm not going to do that next cycle. So next cycle, it's like I might only go in like 50% maybe and split up where I invest. I put some into Greyscale trusts, but a large majority probably, I'm guessing, will end up going into like Bitcoin ETFs because of like the big liquidity and just the market cap of Bitcoin. I mean, if you look at the trusts for Greyscale, they're actually very small in comparison to native crypto, especially like the market cap of Bitcoin. I mean, they were really small. Like in the bear market, man, they're really small. So I can't go in with a ton of money. So I'm not going to do that. I'm just going to allocate some to the Greyscale trust, but probably largely the ETFs that are out there, like the Bitcoin ETFs that are available. And, you know, I'm going to assume if I get in the bear market and buy into the Bitcoin ETFs, that I can probably reasonably assume that I can get like at least a 2x to 3x, maybe more, but you know, probably a little bit more conservative for next cycle, like at least a 2x to 3x probably, if I get in the bear market. So I'll be watching what happens with Bitcoin as we enter, you know, as the cycle ends. As the bear market starts, I'll be watching the price action, and that's where I'm going to really be paying attention to it after this cycle, because I want to get in with a good portion of my investments into Bitcoin ETFs next cycle. So that's kind of what I'm thinking right now. It's like I want to, whatever I don't go into, by the way, into Bitcoin ETFs or Greyscale trusts or native crypto or whatever related to crypto, I will allocate, you know, to different places. I'll keep a large portion in index funds. I'll keep a large portion in high yield dividend ETFs. I will actually go into some stocks related to crypto that are probably going to perform very well this cycle, and I think will perform very well next cycle. So like Coinbase stock, I'll buy MicroStrategy in the bear market, and in the bear market I will also buy some of the Bitcoin miners, you know, because I think they're going to do very well next cycle. Like MicroStrategy, even right now from current price points, I wish I had bought MicroStrategy. I have some MicroStrategy stock now that I bought recently in the past month or so, but you know, Caesar thinks MicroStrategy, I think, can get up to like 15 grand per share, which is pretty crazy. It's like a 9 or 10x from where we are right now. So it has insane growth. It's actually far superior to that of Bitcoin. It's far superior to that of Bitcoin, because had you bought MicroStrategy in the bear market and then rode it up to potentially a price of 15,000, that will outperform Bitcoin, you know, and outperform the Bitcoin ETF. So I will go into MicroStrategy, go into Coinbase. I will go into the Bitcoin miners next cycle as well. They're very cyclical. You got to wait, you know, for the super cycles. You got to get in on those, on the bear markets. So those are places you can go to that have bigger liquidity than the Greyscale trust. Like Coinbase stock is very liquid. MicroStrategy stock is very liquid. Like it just, you have no problem with liquidity on those things, and they perform very well. So even if we see reduced returns, like in future cycles, on individual cryptos like Bitcoin or Ethereum, etc., you still could potentially make a lot of money by investing in the companies that were related to it, like Coinbase or the Bitcoin miners, or even the ancillary companies like MicroStrategy. It's not really related to. It is kind of, because they hold a lot of Bitcoin on their balance sheet, but they don't really have anything to do with trading or mining a Bitcoin. But they're just kind of, they're along for the ride because there's such a big name. Michael Saylor has such a big name, very big. So that's kind of the plan for me. That's what I'm thinking. So I would suggest, I know it's like long range planning, but this is, I always find that planning makes perfect, like they say, right? If you have a plan, it's easy to execute. Like, it's easy to execute. Like with anything, like you got to plan your stuff, like plan rotation, right? Plan rotation. So I have a plan for rotation, like, and what that will allow me to do is, like, very quickly, I'll be able to just follow a checklist. Okay, it's like, is this a good price to cash out? Okay, what's the price of the other trust I want to move into? Does that look good? Okay, execute. Sell some shares of LTCN, move it into GXLM, or move it into whatever. You know what I mean? And so by having a plan, I kind of having thought that through, I'll be able to move very quickly. And that's what you want to do. You also do, and that allows you to, like, when you cash out, you can move very quickly. Like, you don't want to, cash out and then have your money just sit in cash for like 6 months doing nothing. It's better to put it into, in my opinion, like things like an index fund or high yield dividend ETF that performs well. Things like that actually grow your wealth. You want to grow your wealth as much as you can, and then you have more available to you if you want to reinvest in the next bear market. And then you could just really rocket your gains. You know what I mean? So, and how much you put in next cycle, that's up to you. Like this cycle, like I said, I'm putting in the vast bulk of everything, like 99% into Greyscale. I won't do that next cycle. Even when I account for like Bitcoin ETFs and Greyscale stuff, it's not going to be more than 50%. I'm going down, like in the amount of the percentage of my portfolio that I'm going to put in there, and the rest will be in like less exciting but also wealth growing things like index funds, growth stocks, and dividend ETFs. So just something to keep in mind. As always, like I said, this isn't financial advice, just some thoughts, and it's my plan right now with where things stand right now with me. So if you haven't come up with a plan, start to put one together, start to do some research. If you're like me and you're trying to figure out like what ETFs, dividend ETFs to get into after you cash out, well then just make a list and check them like in December or January, almost a year from now, 10 months from now. And see how they're performing, see if they still make sense for you to get into. And the nice thing is with the dividend ETFs, more and more seem to come out like every month or every couple months, which is great. However, I've learned it's better to wait so you have at least like 6 months of data to look at from the chart, just to make sure that there isn't NAV erosion. The last thing you want to do is take your profits from Greyscale and see them wither away. Like, for example, what if you put all your money from Greyscale profits into Tesla, for example, and over the course of a year, you saw it erode by 50%. That's a massive deal. It doesn't matter if they're paying 50% in distributions. It doesn't matter. Like, you're on the back end, your wealth is getting destroyed, and that's not a good plan to maintain your wealth or grow your wealth. So you gotta do your research, make sure you're getting into something that's going to benefit you long term, and that's the name of the game. So, all right, that's it for this video. If you guys have questions, comments, leave them down below, or join Discord and join the conversation. We talk about dividends, crypto, Greyscale, all that kind of stuff. If you're not a part of it, it's free to join. We have a lot of people now. It's a great community. So click the link in the pinned comment below to get to Discord, and you can join the community. Hope to see you there. I will see you guys in the next video. Until then, you guys take care and enjoy your Saturday.